Let's move to transaction 2. Transaction 2, Mary Jo met with the loan officer from the bank and took out a $40,000 loan. The loan was to be repaid in equal principal payments over 4 years, so that would be $10,000 per year. The interest rate was 10%, and the interest was to be paid at the end of each year when the principal payment was made. Now, she took this loan out on January 1st, so her first principal payment and interest payment will be on December 31st of her first year. Let's record the journal entry. She obtains a loan which causes her cash balance to increase. So let's record a left-hand side to cash, which is an asset. The balance increases by $40,000. She's obtained a loan, so the funding that she's obtained here has created a liability for the Garden Spot. We'll call that a loan payable. We could call it a loan from the bank if we wanted to. I'll just call it a loan payable. It's a liability. It increases by $40,000, so that is a right side entry or a credit in the journal entry. Let's post this to the respective T accounts. The left side entry will post to the left side of the cash T account, which you see already has transaction 1 posted into it. So we will add transaction 2 to the left side of the cash T account. And we need to create a loan payable account because we haven't used one yet. So let's put that over here in the liability section. It, of course, has a beginning balance on January 1st of 0 because no transactions have involved that account yet. We'll put post our right side entry into the right side of the loan payable T account, and we'll make sure to denote that as being associated with transaction 2. Let's make sure our balance sheet equation stays in balance. Cash, which is an asset, is up by $40,000. Loan payable, which is a liability, is up by $40,000. Both sides of the equation increase by $40,000, so the equation stays in balance. We're happy again. Now, here's a question I want to pose to you. What about the interest that the company is going to owe on this loan? Mary Jo at the Garden Spot took the loan out on January 1st. Does the Garden Spot need to record a liability on January 1st for the interest that it's going to owe? The answer is no, not on January 1st. To record a liability, we have to feel certain that a future obligation or a future payment will be made. We have to be able to reasonably estimate the amount of that future payment, and the event that has caused that obligation to be incurred has to have already happened. With interest, we know that a future payment will be made, and that will be made on December 31st. We know how much interest will be paid on December 31st. It would be the 10% times the $40,000 loan amount, or $4,000. But the event that causes that obligation to be incurred has not yet happened. What causes the obligation to pay interest is the passage of time. The Garden Spot has to have had use of the money for a period of time in order for it to have an obligation to pay the interest on that loan. You can alternatively think about it this way. If Mary Jo, as a representative of the Garden Spot, went back to the bank on the same day she took out the loan, January 1st, and said, "I've changed my mind, I don't want the loan," she would give the $40,000 back to the bank, and she would owe no interest because no time had passed and she had not had use of the money to generate any benefit.